Everyone, and welcome in today's market wrap-up. We have two special guests with us today, Cantonese Cat and Matt. How are you guys?
Doing great.
Doing doing just fine, Luca. Always enjoy doing these things with you.
Two guys, and it has been a pretty tough week, pretty volatile. How are you guys feeling?
A lot of my stocks just did nothing for the week. I think it was fine. What about you, Matt?
Yeah, I'm pretty much enjoying how things are just working out this cycle. I mean, there's like a lot of fear when things looking ready to break out, and that's usually a perfect catalyst for things to just keep on going. The wall of worry.
Yep, have seen a lot of calls for a cycle top these days.
Yeah, the top callers never stop doing that, and they will also continue to do that no matter what. One of these days, they'll be correct, and they may be correct now. Who knows? We'll talk about it today, I guess, right, Luca?
Yeah, that's true. I have something very interesting I want to share here for the IWM. Because the IWM is really a very important piece in our overall risk on environment thesis, and we can track directly how the market interprets this risk on environment as a whole by tracking how small caps, which are the riskiest assets one can buy, how they perform. Because based on how they perform, we can assess the overall market sentiment. And we see here that the IWM is currently sitting at all-time highs, right? It is testing this high time frame resistance range. Yes, it has rejected on the low time frames, but it is also holding up pretty well. And something I'm tracking here is the one-day bull market support band, which ever since the broader markets bottomed out back in early April, it has been a very strong reversal point and a support range. So we see here how many times it acted as a reversal point since early April. Each time it got tested, it acted as a strong bounce zone, right? And now it is holding up pretty well here as we can see here. And moving forward, I believe that the best approach currently on the low time frames is to remain somewhat cautious and conservative on the low time frames, because when we test the resistance range, every time we want to be somewhat cautious, ready for a potential rejection, but not necessarily bearish until there is a clear confirmation of a reversal. I believe that the best approach is to remain somewhat more conservative and flexible, as I've said in many of my prior videos for those that watch them, or in many of my prior posts on X. I think that flexibility is really the most important asset you should have as an investor. And being able to adapt yourself quickly to new market circumstances is one of the most important assets you should have as an investor. A very big mistake I've seen over the last couple of days, which is also the reason why I believe we're currently witnessing this pullback and cool down on the low time frames, is because of over leveraged traders. So traders essentially over leverage themselves on the short term, thinking that they're going to make more profits, and market makers simply use them as a counterparty. And for that reason, I think that moving forward, the best approach to both enjoy the optionality of upside while also having a more conservative and essentially being able to adapt yourself as we move, as we go on and near the cycle top, will be to focus on your spot holdings and your broader strategy moving forward, not to try to catch the short-term volatility, because this is just noise on the low time frames. There are just headlines that come out, and a lot of people are unfortunately scared because they don't take the time to do their due diligence and their fundamental analysis, and they just go on with the flow, which I think is a mistake. So having a, a bias in the markets and having a strategy that you adapt as you go is very much so different than simply following the headlines and just going with the flow, going with the sentiment, being bearish when the prices are down and being bullish when the prices are up. That's essentially how you get wrecked, and that's how market makers always have a counterparty to trade with. So what do you guys think on this? What do you guys what's your feeling on the IWM and small caps right now?
I'll let you go first, Kat.
I mean, I want to say that whenever things get close to all-time highs here, and whenever things get to certain FIP levels, and it looks like there's a lot of velocity, a lot of momentum going on, the right thing to do is probably to not bet against the trend. Even there is some high time frame resistance there that you're seeing there, but there's also a lot of momentum is holding support, so the bias is going to be to the upside. That's all I have to say.
Yeah, and I can just switch to my screens that I just wanted to show what I'm seeing here with a couple of views on log scale and linear scale. And the first one is when you look at a monthly chart, this is, in my view, yes, it's resistance. It's obvious resistance. It's a 2021 high, also a 2024 high. Also, it's can't break out right now. So it's obvious resistance. We all know that. But I think what we can see and take away from this is really, it's never really had two consecutive monthly candles above this 886 ever in history, right? And this is about to have the second consecutive monthly candle close above that 233.20 in history. So this is a trend change. It's never happened before. So that's one bullish thing, right, on log scale that we can see. And also, when we look on linear scale here, I do have my Gannon. Like, this thing is pretty accurate how it has never done this before either, right? It's a very obvious previous resistance here from back in 2024, flipping to resistance here. And that really is around the 236, 235 zone too, which is really telling me that maybe 289, 290 is coming next. So even though it's not breaking into all-time highs yet and people are screaming, oh, it's a triple top or whatever you want to call it, I just think the momentum is there to break it because we're seeing stuff that has never happened before with IWM. And it's happening when there's really bearish sentiment, I think, when this is all developing. So this is, in my view, it cannot be even more bullish than it actually is. Like the underlying tone of bullishness is just very powerful, is what I'm seeing.
Well, I didn't know that we're going to show charts. If you're going to do that, if you want to flip it
Well,
over to me, I can show some.
Well, go ahead. You can show your chart, Kat. Back to you. Come on now. Yeah.
Okay, thank you very much, Matt. So I think if you just kind of zoom in here, what's going on? Well, you have 5 months of an uptrend here on increasing volume right into resistance. Actually, it doesn't look too bad. You also had a capitulation candle over here in April too. A lot of the small caps have traded hands from the weak to the strong with increasing volume pushing up. So it's looking pretty decent. Looks like we might be hitting a third time. That might be the charm here. Now I'm going to show you in terms of what I see in terms of liquidity cycles ever since the great financial crisis, ever since this happened when banks can't fail anymore. We've just been going through increasing global liquidity. This is the M2 Global Liquidity Index. Again, it's the summation of the US, Japan, China, Euro, and the Great Britain, which isn't so great, I would argue. I'm sorry about the Brits if you're listening, but I'm a little bit biased. But anyway, but you can see that basically every single time when you have a liquidity having a hard time kind of breaking through this, when you have a bear market going on with IWM, which is Russell 2000, which are small cap stocks, they're going to be the most economically sensitive to any liquidity crunch, right? If you can't break through, there's uncertainty with global liquidity. You're going to end up having a bear market, and that happened over here. That happened over here when you have a hard time breaking through. Let me see if I can broaden that up a little bit. When you have a hard time breaking through this, liquidity zone of resistance over there. Same thing over here. When you have a hard time breaking through this, liquidity resistance over here, is when you have the bear market. But eventually it'll break through. Here we also have a long resistance here for like about 2.5 years. We're able to break through and back test that. And right now, if you also look at this cycle over here, also look at very similar thing from last cycle as well, there's a lag. For whatever reason, there's a lag. Even if you have a breakout, the lag can happen for like a whole year, which we did, have last year, have a lag for like the entire year. So far, I think we're having very, very similar thing. We're almost lagging with the global liquidity breakout and back test, and we're lagging for a whole year. So when that happens, I think a lot of the liquidity is going to large caps, but eventually, if we continue to have breakout of global liquidity, I think it will have to rotate into small caps because they've been accumulating this for almost 2 or 3 years now. And whenever they accumulate, they're not going to want to sell it for cheap, and they want to probably distribute and sell it for higher. And I think we're getting to the point where we might be about to do that. On top of that, you also look at Ichimoku. You kind of stuck in a range here between this all-time high resistance here and the Ichimoku cloud here for a very long time. We have really tested this Ichimoku cloud like crazy here, like never before. And we have shown that we've got enough demand down here below, especially with this big giant hammer candle over here, with increasing volume pushing into a resistance zone. I never like to say like be bullish at resistance, but I think this is one of those times that I think it's okay to consider doing that. The other thing too is trend's always your friend. Bullish band is expanding again, and it's just starting to kind of expand here on the upper part here for the first time. So I do think that we have more chances. Sometimes when you touch the lower Bollinger Band or get close to touching the lower Bollinger Band here on the monthly, to me, that's usually a pretty extremely bullish event, unless if you die, which, if you didn't die, if you get close to the lower Bollinger Band, that's like bye, 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 bye right there. And right now we are getting back to the top of the Bollinger Band, and the Bollinger Band's expanding here. To me, I think that might signal a more volatile move, on the way up, kind of like it did over here, right? With COVID, we punched through the Bollinger Band here on the monthly, but we didn't die. We came back, reclaimed the 20 like we did just now. And then right now we're showing a little bit of signs of expansion like we did over here. If you're looking at the 2-month, it would even be a little bit more apparent here. Let me get rid of all these labels over here. I don't think I really need any of that anymore. If you look at the 2-month, it'll be even more apparent, right? You have a Bollinger Band squeeze over here and expansion. You have a Bollinger Band squeeze over here and expansion. So that tells me that consolidation seems to be over, and we're about to get some pretty volatile moves that are going to come next. That's what I'm seeing on my charts, guys.
Beautiful.
Luca, anything to add to that?
Yeah, I completely agree with that. And I think that moving forward, there will be this massive risk on environment. So this week, we actually had some great macroeconomic data that came out. So as I've shared in one of my reports here, we have the PCE that came out, right? And so essentially, we have the PCE, which came in at 0.3%, which is great. I mean, it is somewhat elevated, but I believe that it is in the range that the Fed is trying to target. They have said that they're not looking for 2% anymore, but instead they're looking for 3 to 4%. And I think that this is all part of the broader inflationary environment we're nearing. And we talked about in our past conferences about the roaring 20s. And I think that what they said about inflation will actually play a major role moving forward. So I think that they know what's coming next. And yeah, but that's another point. The main point I'm trying to make here is the macro data that came out this week. So we had a GDP coming in at 3.8%, confirming that the economy is much more resilient than believed. And this supports the soft landing narrative. So then we had the personal income and spending. The personal income month over month came in at 0.4%, while the consumer spending rose by 0.6%. These suggest that the consumers are also resilient, that the personal income is high, that the consumer spending is also somewhat elevated, and so that also supports the soft landing narrative. And moving forward, the main point I'm trying to make here is that we're going to need a very strong narrative. In order to have risk on environment, we first need a strong narrative that is the main narrative in the whole market. So if we think about what happened back in early 2025, we didn't really have any sort of fundamentals that have changed. So we had the stagflation fears, we had the recessionary fears, we had the fears of tariffs. But aside from that, and aside from a moderate contraction because of a massive spike in imports, we didn't really have any sort of changes in the overall fundamentals. I mean, the labor market was still strong, the consumer spending was still strong, and so we didn't have any sort of changes. That's why we didn't see the Fed's intervention then. So, as a lot of people were calling back then for emergency rate cuts, we didn't see that because it wasn't the case. And so now I expect that we're going to see something very similar to that, but this time the speculation will be on the upside, with people calling for soft landing, people talking about, rate cuts and how new liquidity will get injected in the financial markets. I believe that correlations with what happened in China and with the Hang Seng Index will also be made. So how the Fed will transition away from their quantitative tightening measures and step into a quantitative easing environment where risk assets are primed for growth. And so I think that's what we're going to see moving forward. And that will drive the risk appetite much, much higher. and also the euphoria. Now, after that, and after we have a big move to the upside going forward in risk assets, I personally believe, because I'm more conservative, my personal risk profile is somewhat more conservative. I personally believe that after this decoupling phase and after this risk-on environment, we're going to have an economic downturn. Because as I've discussed many times, even with you guys, I believe that Fed's intervention, whether it's to hike rates to combat out of control inflation, or whether it's to cut rates to stimulate growth, that signals that the trajectory of the economy isn't sustainable anymore. So the Fed has to intervene in order to change it. And that signals that there's an underlying issue that the Fed is trying to solve. Now, my main thesis has been that after we see this risk-on environment and decoupling phase from the traditional equities in the S&P 500, mainly driven by the extreme risk appetite I believe we're going to see in the next couple of weeks and months, that market makers will use this as an opportunity to distribute. That's my personal belief. Now, it depends whether we have any sort of changes in the labor market or whether we have any sort of changes in overall macroeconomic environment. So that will be something that we'll have to track. But we could also have a more positive outcome, which is where the Fed actually pulls off a soft landing. But I think that in order to confirm that, and in order to confirm that it isn't just a narrative and that it can become a reality, we need to have additional confluences that point towards the fact that we're going to have that soft landing. Because historically, mostly every time the Fed has transitioned away from a quantitative tightening environment and has reduced rates in order to stimulate consumption, they have done that for a reason. And most of the times, it preceded a recession. So what do you guys think on that? Do you think that we could have an economic downturn that market makers use this risk-on environment in order to distribute before that comes? Or do you think we could have a soft landing moving forward?
Matt, go ahead. I want to hear your thoughts.
Well, I think with the rate cuts, I think it was pretty obvious that some risk on stuff was going to happen because of some signs, especially like Tesla was showing signs of wanting to break out. Even Neo and Rivian, like that just shows me that they're going to start cutting rates, and that's good for car companies, right? That's really good for them. So, but I think besides the rate cuts, I don't really see any kind of downturn possible. And the reason why is I'm going to show a chart here. Let me just share my screen. Is because the semiconductors are showing me that things are going to just outgrow any kind of fear. This is, to me, it's showing massive growth is on the horizon, and this is showing behavior that it's really, really ready to go. Right? These are monthly candles, and just based off my Gantt chart here, it's a breakout. And not only that, this is the 45-degree angle here, which was a big support zone that was lost, and now it's getting reclaimed again. So I think we're going to outgrow any kind of fears. And also, when we just look at the ARKK chart too, this is just showing me that it wants to outgrow any kind of recessionary fears as well, because it's flipping previous resistance levels right here, right? This is the 45, just resistance, 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 flipping to support. Next level is 90s, and the next level after that is the 200s. So I think the growth stocks and I think the semiconductors are just showing us that any kind of recessionary fears that we might have, even with rate cuts, it's just going to keep everything strong. Everything's just going to keep going higher and higher and higher, and this could be possibly one of the most explosive rallies we have ever seen. Really, that's what I'm thinking. Kat?
Yeah, you want to pass over. Thank
Mhm.
you. I share very similar views with you, which I hope is not a little bit of an echo chamber sometimes. If you look at the 2-year and 10-year yields, and I never really like to just listen to what the Fed has to say because they are reactionary. Like Lucas said, they are reactionary to the economy. And even Jerome Powell himself says that they are data dependent. So let's look at the data. What data do you have? Well, you have the market data. Market data tells you how the economy will act sometimes, and I like to look at the yields for the 2-year and the 10-year because the Fed generally like to more or less kind of follow these. if anything, these yields are a little bit more of a crystal ball in terms of what the Fed is going to do. Look at a 2-year yield over here. It looks like a clear distribution. I've kind of charted this for a while. 2-year yield has been looking very weak for a long time. This looks very much of a distributive kind of thing. And if you have 2-year yield dropping kind of like the way it is, and it looks like we're kind of hitting a resistance zone again, you've got a little bit of a falling 3 pattern over here, by the way, red, green, 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 wasn't able to really truly break back above here, and you're also hitting a resistance zone. I think yields are going to go down. You already kind of knew that even before the Fed, announced like they're going to cut. It just looks weak to you. 10-year, very similar thing. You do a line over here, and you can see that it's basically going through the same thing. It looks very, very weak right now. It looks very distributive, and it doesn't really look like it's gonna, just keep pushing up higher. Although a lot of people are still talking about inflation, a lot of people are still talking about rate cuts not going to be fast enough, to worry about the recession, things like that. It looks like yields are signaling that the Fed is going to continue to cut down, and that's going to be pretty beneficial for risk assets. Now, the biggest question is, how long are we going to end up having a risk on environment, which is what I think we're all kind of seeing, all three of us are seeing. The question is how long? To me, I don't necessarily, now this is just based on looking at the charts here. It is true that the Fed is always trying to do something to try to fix something, right? They've been doing it for decades. There are always problems with the economy, but they're always trying to cut rates and cut yields to try to fix something. The reality, when I was kind of back testing this all the way back to the 60s, I really am seeing that whenever the Fed end up just cutting a little bit, unless it's like something drastic, right? Like back in the dot-com bubble crash, and also back in the Great Financial Crisis, unless it was absolutely drastic, which they actually cut it pretty drastically here during the COVID era. But unless it was absolutely drastic, most of the time, actually, if they cut rates, and it makes complete sense because it makes it a lot easier for smaller companies to get liquidity, to borrow money, and also makes large caps be more exposed to liquidity in general. Almost every single time when they try to cut rates, the S&P 500 goes up, right? Here. You can look at the arrows. I don't have to kind of point out everything to you. So the narrative that when the Fed cuts rates and the S&P 500 and the overall stock market would just go down, it's not necessarily true. It could either go down or it could go up. And it looks like, based on backtracking this data, the majority of the time seems to be up. Now, the question would be, yes, if you're looking at something that's extremely bad, like the dot-com bubble crash or the Great Financial Crisis there, are we facing one of these bad recession and depression kind of thing, right? The way I see it, it's not necessarily have to do with whether or not the Fed cuts or not, but whether or not we have, like Lucas said, whether or not we have gone to the point where we are just way too over leveraged, and that that it's a significant pullback and a significant period of like a lost decade would have to come. I'm going to go back in history here. I know you're talking about the Roaring 20s. I'm going to go back here to the SPX or SP 500. This is a 6-month chart. So each of these candles represents half a year of price action. And I'm showing the Bollinger Band here. Whenever you have things that are closing above the Bollinger Band, is way overstretched. The 1920s, how many months do we have closed above the upper Bollinger Band here on the 6-month chart? I mean, I'm going to tell you right now is 8 months, right? Well, guess what happens when you close about 4 years way outside the 6-month Bollinger Band? You're going to end up having a major crash that happened for over a decade. That's exactly what happened after that, right? You do have in the 50s post-war, you do have a little bit of like 2 years of exuberance that end up having exhaustion over here, and up touching low Bollinger Band over here too. But that hasn't really happened again until the dot-com bubble. You see how overstretched we were during the dot-com bubble. How many candles did we close above the upper Bollinger Band here on the 6-month chart? 10 candles, right? Guess what happens? You're going to touch the 20-period moving average. You're going to try to get back to the upper Bollinger Band again, but you don't have the energy, so you touch the lower Bollinger Band to grab the liquidity, final liquidity, before you start a beautiful bull market here again. Do we have that issue right now? Well, you can argue that here during the money printing era of 2020, 2021, yes, we were a little bit exuberant, and that's when you have to crash of 2022 that came, right? What about now? Do we have all kinds of candles that are closing up, above the upper Bollinger Band? Maybe you can argue that, but how long can this go on? It can go on for years. It can go on for like 2, 3, 4, 5 years. It's really impossible for us to really be able to tell. And the final point I want to make here, this is the monthly chart of IWM, just looking at the past cycles, right? Here's a cycle here, here's a cycle here, here's a cycle here. Whenever you end up breaking into all-time high, this cycle went on for, how long did it go on for? For like 3 years. This cycle, how long did it go on for? For about 2 years. This cycle here went on for another year. How long is this going to happen? I don't know. Is it going to be a couple of months? Is it going to be a year? Is it going to be 2 years? Is it going to be 3 years? We're forming a big giant base over here that lasted for like 3, 4 years. Is it going to be 5 years? I don't know. I just don't know, right? So I do think that it's important to maintain some level of flexibility to see where things are. But currently, I just see something that's really bullish. I just don't know how long it's going to last. Back to you guys, Luca. Sorry, I took up a lot of time. I'm just really passionate about like talking these kinds of things about economic cycles, things like that. But Luca, what do you think?
Yeah, man. I mean, I definitely agree with that. And this is a beautiful chart for the IWM, and I definitely agree. I mean, moving forward, I think that it is very likely that as we enter this risk-on environment, small caps are very likely to outperform, both from this risk appetite perspective as well as from a fundamental perspective, because the markets price in rate cuts, cheaper loans, and these kinds of things, which are very bullish for small caps. Now, if we think about how small caps fund their growth and their operations, because they're a very competitive industry, we have to think about this. They can either fund them through loans, to debt, actually, or through equity. So over the last couple of years, because we have been in a quantitative tightening environment where the Fed has had interest rates high, small caps didn't have the option of debt because the interest rates were high. So they could either issue debt, buy bonds, or they could take on loans, but both were very expensive. So most small caps took on the equity side. So they diluted their shares in order to grow their operations and essentially remain competitive within the small cap industry. Now, because that happened, we had small cap significantly underperforming the traditional equities in the S&P 500 or other big caps, largely because investors first weren't chasing high returns because they didn't have anything to hedge against. So they didn't have a high inflation. And they also underperformed because they have diluted their shares, which has a very high weight on the price action. But moving forward, because the Fed is expected to reduce rates, I believe that it is likely we're going to see the markets pricing in this by leading to an outperformance of small caps in the next couple of weeks and months. Now, something I want to touch on here is Bitcoin. So a lot of people have been really worried about Bitcoin and the overall market structure and the price action. It is true that the price action is looking sort of weak right now on the low time frames because the price has broken both below the 2-day bull market support band, which has been a strong reversal point over the last couple of months. So we see here that it initially acted as a resistance once it was lost back in mid-August. Then it acted as a support once it was reclaimed, but then it failed to hold, and now it seems to be acting as a resistance once again. And the price also lost the prior support range, aligning with the late May highs, which is yet another sign of weakness on the low time frames. So my view right now is that in the bearish scenario, on the short term, where the price fails to reclaim the lost support range aligning with the late May highs, we could have a rejection here, leading to a deeper pullback inside this high time frame support range aligning with the November to December highs of 2024 before a durable reversal to the upside. Now, this would be essentially the bearish scenario I'm currently seeing for Bitcoin, and a lot of people are worried about this, but the weak seasonality has played out, and October has historically been a very strong month for Bitcoin. We're now entering it. So for that reason, I believe that we could have this flush in the next couple of days in case the price fails to reclaim the support range. But other than that, I believe that the midterm is very bullish moving forward. And I think that if you're not over leveraged or you're not overexposed, you have nothing to worry about here. So I personally am the type of investor who takes the markets level by level. And I believe that this is simply the best approach, because by doing this, you always remain objective. So you always track objective fundamentals. You always look at the objective reality instead of seeking out biases and confirmation tools, confirmation narratives. So that way you adapt yourself to the real circumstances of the markets. And I believe this is the best way. Until there is a proper invalidation of the high time frame trend, like a break below $104,000 with a weekly close, which would be a clear sign of weakness on the midterm, and that would be an invalidation. But if we don't see that moving forward, I believe that the trend remains intact, and I think that there is nothing to worry about, right? In case the price breaks below it, yes, there is something to worry about. So you can hedge part of your spot holdings to mitigate the short-term downside risk, but you have to approach the markets level by level. So far, we're sitting above this massive high time frame support range, which the price hasn't even tested yet. So that's my main point right now on Bitcoin on the low time frames. And something I've been seeing a lot of people worry is a 3-month close. So a lot of people have been comparing the current 3-month close with what happened back in 2021. In order for the 3-month close to be the same length and at the same level, essentially, with what happened back in 2021, the price of Bitcoin should pull back to around $82,000 within the next 2 days. So I don't think that these two are the same. I think that they're completely different. These are two completely different candles in two completely different environments. Because back here, the Fed was transitioning towards a quantitative tightening environment, and the markets were pricing in tightening, right? And fewer liquidity and these sort of stuff, which of course aren't positive for risk assets in particular. Now, however, the markets are pricing in the complete opposite. The Fed transitioning away from quantitative tightening and into a quantitative easing environment where liquidity is plenty and credits are more accessible. And so that's what the markets are currently pricing in. So comparing these two environments, which are completely different, in my opinion, is a mistake. So what do you guys think on the 3-month close right now? What's your view on this?
In my opinion, I think it's still pretty bullish overall, but I think it's just waiting for more consolidation. And I kind of agree that if it can't start to go higher soon, it might need to one more flush lower.
I think if you're looking at higher time frame candlesticks, sometimes these like scary looking gravestone doji don't always work out. I think that's kind of my opinion. Um, it it's scary looking, right? I mean, looking at the big wick above, yeah, sure, but to me, I cannot really be that bearish on Bitcoin in the higher time frame when the Russell 2000 and small caps look like they're about to break out. I just cannot. So I'm gonna be leaning a little bit more, more optimistic here with Bitcoin here moving forward. Lower time frame, I'm completely agreeing. Unless if Bitcoin closes, this week miraculously by the end of today's close in just like 5 or 6 hours or so. If it closes above like 112 K or something like that, then I would be like, But if it doesn't, then yeah, lower level is possible. Is always possible. But that's more like a lower time frame thought. But higher time frame, that worried about that little, gravestone doji there, because it doesn't make sense.
Yep. I also have here Ethereum I want to talk about, because a lot of people have been scared of Ethereum over the last couple of days because it has pulled back. So it has underperformed Bitcoin over the last couple of days, but has significantly outperformed it since it bottomed out back in early April. Now, I believe this is a complete normal pullback after such an aggressive rally we've seen over the last couple of months. So, not expecting any sort of substantial pullback is a mistake after such an aggressive move to the upside. Now, purely from a structural perspective, this is looking like a classic breakout retest pattern where the price has initially broken above this high time frame resistance range, which has marked local tops all throughout 2024. We see here each time this range got tested, we had a massive crash in Ethereum. And now we had Ethereum breaking above it, now consolidating above it, which I believe is a bullish indication. And I think that this is just a reaccumulation phase before a continuation to the upside. I think there's nothing to worry about. The weekly bull market support band, which has been a very strong reversal point over the last couple of years, is currently following the price and catching up with the price, and is sitting right below the current levels. And I believe that in case Ethereum breaks below this high time frame support range, which is a low probability scenario for me personally, I personally expect that it is very likely to just continue consolidating within it before a reversal to the upside. But in case we have a breakdown in the next couple of days, then it will test the weekly bull market support band, which I expect to act as a reversal point. And so we have a lot of strong support levels below us. So I think that there's no reason to panic as long as these supports are still below us. Now, in case Ethereum would, in the bear scenario, would break below this high time frame support range, then test the weekly bull market support band, maybe bounce on the low time frames, but then fail to hold it and break below it, that would be a warning sign. And that would be a clear sign of weakness. And in that case, I believe that if it is actually a distribution, this ended up being just a distribution. First of all, it would be a completely failed cycle. And Ethereum just formed a very small all-time high, right? It got 1%, 2% away from the prior all-time high, above it, and then pulled back. So to see something like this, Ethereum having the distribution phase here and then pulling back would be an absolutely failed cycle, which I personally don't expect is going to happen considering the current fundamentals in the overall markets, considering the macroeconomic environment and everything going on with the Bitcoin dominance, the weakness there, and everything going on with on-chain data. I think it's a very low likelihood scenario, but in case it happens, even though you're bullish here, while this high time frame support range is tested, you can simply adapt yourself. And I think that this is the best approach moving forward, to keep a diverse portfolio, to keep some cash on the side so you can adapt yourself using that cash. I personally keep around 6 to 7% of both my equity as well as my crypto portfolios in cash, because that cash not only gives me the opportunity and flexibility to scale into opportunities and good risk reward setups once I identify them, but that also gives me the flexibility I need in order to hedge my spot holdings in case there is a technical breakdown exactly like this one would be. Because here, in case Ethereum breaks below the weekly bull market support band, I can simply hedge part of my spot holdings in order to mitigate the short-term downside risk. And by doing this, I avoid this downtrend and potential reversal to the downside. Even though I remain bullish and even though my main thesis would be wrong, I don't have to suffer as much because I can adapt myself. And I think, as I've said in the beginning of this market talk, that flexibility is really the most important asset that you should have as an investor. And considering how late we are in the cycle, I believe that having a diversified portfolio and also keeping some cash on the side in order to adapt yourself quickly in case there's some sort of invalidation, and also adapting yourself as we move closer to the cycle top, because even if the base scenario plays out, we're going to have bigger and bigger swings as we move closer to the cycle top, because that gives market makers more a larger trading spread that they can trade. So by having a larger trading spread, they can distribute more easily. And that's why we generally tend to have and see more volatility as we move closer to the cycle top. And by having a diversified portfolio and also keeping some cash on the side, you can sort of mitigate that volatility and you can remain objective even in the most volatile times. So that's my current approach. And That's how I view the best approach moving forward. And that's also my interpretation on Ethereum. What do you guys think on Ethereum and the current market structure?
Yeah, I'll just share my screen here just so I can illustrate it a little bit better. And here it is, right? This is the 886 fib, and this is a breakout rejection at previous all-time highs, and it's so far holding. Nice liquidity grab underneath it, staying above that 4,006. So that's all what I'll be watching for today's weekly candle close. But I think there's a high probability that this zone is going to hold. And this is it's clear to see, right? It's very visual, clear to see previous resistance, resistance, resistance. Even way back here in 2021, it was a resistance at first, but now it's flipping to a support. And I think the likelihood to break out is greater than not, simply because if you just look at total 2 itself, which is everything except for Bitcoin, we are at levels that we haven't really experienced for a long time. Like, we're spending the majority of the time above this 1.46 trillion. This is the most weekly candles ever in history that's been just consolidating at this level. Like, we didn't have that many candles this time, not that many candles this time. So when you just look at this chart, it just looks like it wants to break out. It's just not ready yet. It's not ready to break previous all-time highs just yet. And I think just maybe give it a little bit more time. Maybe it does need to retest one more time, a little bit lower first for total 2, right? Maybe it does need to touch that 1.46 or something before going higher. But to me, the risk reward is just in your favor, just the lower it goes. So I'm expecting a breakout for Ethereum, expecting a breakout for altcoins. And I think overall, when you just look at Bitcoin kind of doing nothing, I think the altcoins and everything else are really kind of holding on levels pretty nicely, which is just showing overall outperformance, really. And like how Kat was saying about that 112 level for Bitcoin, I actually have it illustrated right here on the chart that it is a big previous resistance zone, that 112 zone. Tried to flip it to support, and now it's stuck underneath it, right? So this kind of is important. If it can't break above 112, then yeah, it might have one more flush below. But does that mean it's going to take the altcoins with it? I mean, maybe a little bit, because when you look at that total 2, there is still room to go a little bit lower. But ultimately, I think it's just building a nice foundation until it's ready to just blast off. And the last thing I want to show you too is just the dominance of Ethereum over Bitcoin too when you just compare those two together. Right, we can just take a look with the Ethereum and the Bitcoin chart. And yes, it is losing this 382, but what I really want to illustrate is with the Ichimoku cloud here, how it's really trying to break through the cloud. And all it did with this backtest is just backtest that conversion line there, and it's actually still holding. And I think the monthly candles illustrate what's really going on well right here. It's just not ready to break free of this monthly baseline just yet. But the outperformance, in my opinion, for Ethereum and for the altcoins is still strong. And when you just look at the Bitcoin dominance in general for Bitcoin overall, I think when we look at the weekly chart, it kind of illustrates what's happening perfectly, right? It's a previous support that was lost. And this is just more confluence that it could just keep going down, 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 which means Ethereum and everything else has a high likelihood of continuing higher as well. But does that mean Bitcoin's going to tank? No, I just think there is a probability of, like you said, maybe going back down to 104, maybe 103. And the reason why, because Bitcoin right here could even retest this Fibonacci level right here, which is the 1.272, 103,611. So after the breakout, it could just do one final like liquidity grab underneath it and then send it higher. So there could still be a little bit more underperformance of Bitcoin, but it doesn't mean it's going to tank. It doesn't mean the cycle's over. I just think that the altcoins are still going to outperform Bitcoin. Kat?
Yeah, if you want to pass it on to me, of course you talked about those Ichimoku weekly dominance and
Were you going to talk about it?
Yeah, I have it loaded up right here. It's showing basically
Oh,
the same thing. No, it's good. Like, it's basically we're seeing the same thing. They're ETH showing strength. It's just cooling down. Bitcoin's showing relative weakness. And it's probably going to hold levels pretty decently, but it's until proven otherwise. One thing about Ethereum that I kind of want to talk about from like a cycle perspective is that I basically am seeing a very, very similar pattern here over and over again from prior cycles, where you basically have two deviations on each of these cycles over here. There is a resistance up here, that it has a hard time breaking over for about a year or so. There's a resistance zone over here. It had a hard time breaking above for a couple of years. And here, this is the current resistance zone right here that we have a hard time breaking above for many years, right? When this gets broken out of, usually it precipitates a pretty big move for Ethereum just because there's so much accumulation that's been going on underneath here for many, many years. And eventually, market maker is going to want to distribute. So it's possible to have a little bit more parabolic move up. And now I have this arrow here. Doesn't mean that it's going to go all the way up to like 40,000. But it's just more like an illustration, kind of like, if you ever get like ramen and they have like all kinds of meat and stuff in there, it's not necessarily going to come with it, but it's just for an illustration here to say that something like that could be possible. How high it goes, we don't really know. And how fast, it really depends on liquidity conditions. But each of these cycles also have a trend line up here that looks like an ascending triangle that was going to be very, very bullish, but it ends up having some liquidity grab down below, have a deviation down below here. Here, it did that during COVID, and here we just had a cup and handle that just happened just earlier in the year. And we were able to overcome all that. We were able to break above the liquidity zone. So to me, I think it's just a matter of time that we go up higher on Ethereum. What's the target? I'm going to leave that in terms of speculation here. I have some thoughts, and I think some people might think that I'm crazy, but I'm not going to go into all that. But that's the general idea that I have in terms of cycle. Deviation up top, deviation up top, deviation up top, deviation down below, deviation down below, and deviation down below. Getting back above the zone is not bearish. Back testing that zone is not bearish. That's kind of my overall thought on Ethereum. Now, if you might say, yeah, Bitcoin is not doing much, you're absolutely correct. It's done nothing for the last 3 months, but it has done a heck of a whole lot for the last couple of years. Guess what IWM and other small caps have done? A whole heck of a lot of nothing for the last couple of years, but it's starting to build up momentum over here, right? You can just see this kind of rotation even during past cycle, like not so much during this like crazy 2020 cycle. I think everything just ran up here in a hurry because they're looking to distribute it in a hurry. But here during the cycle before that, maybe around 2016, you can also see that Bitcoin was building a lot of momentum on the way up here. And it finally had to cool down for many, many months, whereas small caps were kind of catching up over here, right? With this big green candle over here where Bitcoin did nothing during November 2016, you have a breakout candle here for the IWM. So these rotations are necessary to keep the cycle going. And then the final chart that I think Matt has in mind that he did not show about altcoins is this. This is the weekly chart for others.
I was saving it for you.
Oh, thank you. I was worried about I have nothing else to talk about. I was gonna bring some like Will Chamberlain or something. I don't know. But this is the others chart. This is the overall cryptocurrency total market cap, excluding the top 10. So this is the real, altcoin stuff that you're talking about here. And breaking above a previous resistance zone over here of the weekly Ichimoku cloud, breaking above and back testing it together with the conversion line is not bearish. Having a wick down below showing that there is demand throughout the week, even though everybody is super scared and bitter, is not bearish. That's kind of what I'm seeing here. So if you're able to show, and you can see the same thing here even on the monthly. On the monthly is breaking above all these different resistance levels over here. We were underneath
even more
the cloud.
bullish.
What's that?
That's even more bullish, yeah.
Yeah, we were underneath the cloud. We broke through that. We were underneath the baseline here. We broke through that. We were underneath the conversion line here. We broke through that. And we are clear. But everybody's scared. So, does it have to come back and backtest the cloud again? Maybe. But I'd argue that we've already done that. And we've been doing a little bit of consolidation sideways over here for about 1.5 years. So I think we are more ready to go than we are not, especially when it comes to consideration looking at Ethereum chart that looks like this. Right. So that is all I have for Ethereum and the overall crypto market, guys. Luca, you want to take back over?
Well, I have a bearish chart I want to share here. So,
better than mine.
No, bearish, I think he said.
Yeah, bearish.
Oh, okay, never mind. I thought you said better chart to share. Like, ugh.
No, so this is the Bitcoin dominance. And I
Oh,
mean,
that's
this is
bullish.
looking just, yeah, I
Very
mean,
bullish.
yeah, I mean, this is looking really, really weak right now. The Bitcoin dominance has broken below the weekly bull market support band. And this is the first durable breakdown of this whole bull market. So we see here each time it got tested throughout this bull market, it acted as a strong reversal point. The first all season we've seen this cycle so far was back in November of 2024 when we had those massive rallies across the altcoin market. But that was just about it, and that was followed by a quick recovery about above the weekly bull market support band, and then it continued to act as a strong support for the next couple of months. And I believe that the Bitcoin events is a very strong indication of the overall risk sentiment. So the way I'm interpreting this is that over the last couple of years, a lot of people have been wishing for a breakdown in the Bitcoin dominance and wishing for an alt season because everybody expected that altcoins normally outperform Bitcoin in a bull market, which was false because we have been in a different macroeconomic environment and conditions have been a bit different than they were in prior cycles. So for that reason, altcoins have underperformed. And over the last couple of years, the Bitcoin events was a strong indication of the overall cycle. So as long as the Bitcoin events kept being bullish, that was bullish for the overall cycle because it suggested that the top isn't in it yet and that the likelihood of having a distribution are very low. But now, the fact that we're seeing the Bitcoin events going lower suggests that the risk appetite has shifted towards towards a greater one. So we're seeing a more aggressive risk appetite right now because the Bitcoin events has broken below. And there has been this very interesting pattern that has played out over the last couple of years with these Fibonacci POIs. So we see here an initial break above the 0.236 Fibonacci POI followed by a consolidation above it. Then it targeted the next Fibonacci POI and then it rejected, broke above it, and then consolidated above it for a couple of weeks or months, and then targeted the next one. And so this has played out over and over again. And the fact that we tested a 0.786 Fibonacci POI, which is really the final Fibonacci POI that is relevant, it rejected, right? And now we're seeing this breakdown. It broke below the 0.618 Fibonacci POI. It broke below the weekly bull market support band. So I think that as long as the Bitcoin events keeps being underneath these strong support points in the past, the risk reward setup is leaning in favor of altcoins. So for that reason, I personally have reduced the exposure I have to Bitcoin. I have increased the exposure I have to altcoins while also keeping my equity portfolio more defensive. So this way, I believe that I can both enjoy the optionality of upside I want, while also having the safety net I need by having exposure to more defensive sectors in my equity portfolio, like consumer staples or healthcare or even treasuries. So that gives me the safety net by reducing the exposure I had to Bitcoin, which is the traditional asset in the crypto market, and by increasing the exposure I have to altcoins, which are the risk assets in the crypto market, I get this optionality of upside as we move deeper into this risk on environment and into what I believe will be an alt season. Right? A lot of people have called for an alt season over the last couple of years, and over time it has really lost its significance because of how many times people have called for one over the last couple of years. But I do think that we're gonna see one. But historically, alt seasons have aligned with cycle top formations because the main reason why we are seeing an alt season in the first place is because of a very high risk appetite in the markets, which is used later on by market makers in order to distribute. So that is why an alt season aligns with a cycle top formation. Moving forward, I believe that a very strong indication will be the Bitcoin omens, and specifically when it bottoms. Because when it bottoms, it signals that the distribution phase is complete. It signals that the the cycle top is very close to being in. And so that is kind of where you want to get more conservative. That is kind of when you want to get more defensive. That doesn't necessarily have to mean that the cycle top is in, but it means that the cycle top is close to being in. So you have to take a more defensive approach, even if prices could go higher in the short to midterm. Now, something else I want to highlight here is the Velo data, which I track quite a lot. So essentially, we're seeing here the price consolidating, slightly going up, while the open interest is going lower. So the open interest, for those that aren't familiar with this, the open interest essentially tracks the whole perpetual positions, so both longs as well as shorts. So by solely assessing the open interest, we cannot determine whether these are longs that have scaled out of the market or whether they are shorts that have capitulated. So the only way we can know this is by looking at the funding rates, which track the ratio between longs and shorts. So here we see funding rates going lower. Now, normally we should see funding rates going lower, but the open interest going higher. And that is a very bullish setup, because if the price, for example, goes down while the open interest is going up and the funding rates are going down, that suggests that bears are doubling down on their shorts. And generally that tends to coincide local bottoms, and I think that this time will not be different. But this time we're seeing the price going up, the open interest going down, suggesting that there are fewer perpetual positions, and the funding rates going down, suggesting that there are either more shorts or less longs. Now, because we have here the open interest going down, this suggests that there is the first scenario described, which is that there are fewer longs. So this suggests this whole explanation is a very strong confirmation tool of the current market sentiment, which we've seen on X. We've seen people calling for a cycle top. We've seen how much engagement those sort of posts get. And by looking at the on-chain data, we can really understand how it has affected the market participants, because now bulls are feeling somewhat uncertain that the bottom might be in. And I believe they are giving up on their longs. They are scaling out of their longs, either taking profits or just completely giving up, because they're feeling very uncertain. Now, I think that this doesn't necessarily have to coincide with the local bottom. As I've highlighted earlier, I believe that in case Bitcoin fails to reclaim the prior support range aligning with the late May highs, we could have one final push lower. But this is a strong indication that the bottom is close to being in. But the setup, I believe, that will mark the actual local bottom will be the price going down, open interest going up, while funding rates are going down, entering negative territories, suggesting that bears are doubling down actively, but doubling down. And that has historically aligned with local bottom formations. Now, another reason why I'm currently cautious on the low timeframes is because of the USDT dominance, which I track quite a lot. So here, looking at the bull market support band, we want to look at the 3-day bull market support band, because this has been the main POI over the last couple of months. We see here that the USDT dominance has broken above a high time frame resistance range, which in the past acted as a strong support point back in June here. Then the USDT dominance lost this support range. Then it acted as a strong resistance for the next couple of months. But now the USDT dominance has broken back above it, which is a sign of strength, which for the broader crypto market is a sign of weakness and a warning signal that we have to pay attention to, because unless the USDT dominance breaks back below this range, which would also align with Bitcoin reclaiming its low support range, aligning with the late May highs. So these are all interconnected. So once the USDT dominance will break back below this high time frame resistance range, the Bitcoin will reclaim its support range. That's how essentially all of this works. But until the USDT dominance breaks below it, right, this setup is bullish on the low time frames. So this is the objective reality we have to adapt. And moving forward, what I would like to see is the USDT dominance breaking back below this range, breaking back below the 3-day bull market support band, and once again taking it as a strong resistance. So we see here that since early April, it has been a strong resistance point. Mostly every time it got tested, it acted as a strong reversal point, as you guys can see here. So for that reason, I would like to see a break back below it to confirm that the midterm is once again bullish and that the most likely outcome moving forward is a bullish continuation on the low timeframes. Until that happens, I think that having a more conservative and flexible approach on the low timeframes is the best move right now. What do you guys think on the USDT dominance?
If you want to, Matt, if you want to flip over to me, I can show a chart here real quick that addresses the dominance question. So instead of looking at just USDT, because obviously USDC is also a very, very important integral part of the stablecoin market now. I basically just sum both USDT dominance and USDC dominant together to show that with those two combined, what is like the overall stablecoin market is doing, which gives me a little bit better picture. When I was charting this, I see some bearish patterns over here. I see that over here you have a right angled, descending triangle over here, and a broken down pretty convincingly. Here you got a little bit of a broadening ascending wedge, which is bearish, broken down over here. Now you got a little bit of a ascending wedge over here. Now these things generally tend to lean a little bit more bearish. If you look at just the USDT dominance, you may not be able to see the structure. But if you actually add the USDC dominance together with it, like this is kind of what I'm picking up here. With that said, it doesn't mean that you should be like all bullish and just because it got rejected up here from the wedge up here, because it's got a little bit of a rising 3 pattern over here on this daily chart, right? You got a green candle over here, you have 3 candles that are not able to break back below that, so you can still have another candle that pushes up, and that could potentially give you a little bit more of a flush again and get everybody all scared, and that could potentially be kind of the end of the correction there for Bitcoin and potentially for the currency market overall. But overall, I'm on a higher time frame. Like look at the biggest structure. I'm not really that scared, because when you look at both of these stablecoins together, it looks like it's a bearish structure. So that's kind of what I'm seeing here. So in a way, it does look like it's in agreement with you. I would like to see it getting rejected here on the top of this wedge, but it's still not anything to be particularly scary to me right now. The other thing too, going back to the Bitcoin dominance falling, one thing is trying to extrapolate from the last 2 cycles in terms of the Bitcoin dominance drop. And I would like to basically do the count of when the Bitcoin dominance dropping to the top of Bitcoin for that cycle. Now, during this cycle, the top was around December 2017 to around January 2018 or so. So I'm going to just say December 2017 here as the line there. Here the cycle top is November 2021, so I'm also going to use that as as a guide there. You can see the timing wise, these things can, even though they are distributive, these things can happen for about 9 to 10 months based on prior cycles, and it can take time for the distribution to happen. So it's hard for me to say whether or not the 4-year cycle, if we're just starting to have that distribution that's just happened a couple months ago, and we start having a little bit more altcoins, including Ethereum, outperforming, that could end up happening anywhere from like 9 to 10 months. And that could put us potentially up to April or May of 2026, if the cycle play out very similar to prior cycles. If you straightly go by the 4-year cycle, we've already extended that a lot further, because Bitcoin dominance just kept on going up a lot higher for longer. So maybe that would be a potential rationale for the 4-year cycle to not be that that timely as you would expect in just a couple months. That would be my argument against the 4-year cycle, because distribution does take time, especially after they've accumulated altcoins for so long and they're looking to distribute at higher prices, and that might not happen that quickly. That is kind of what I'm seeing here, guys. Matt, I don't know if you have anything to kind of add to that.
Well, just with the amount of time, yeah, I don't really have much to add. You basically covered it with the dominance of Tether. But when it comes to others here about it's going to be just a short cycle. I just want to put into perspective, really, since breaking into all-time highs, how long the altcoin season was for the past 2 cycles, right? And from when it broke into all-time highs, it was 580 days, right? And then from the new all-time highs in 2021, it was about 1 year, right, to the top. And we haven't even broken into all-time highs yet people are talking about the cycle being over. So I mean, even if you cut it in half, like say it was like 600 and cut it in half, it's like 300. Even you cut it in half, it's still like 180 days, right? That's still 6 more months once it breaks into all-time highs, and we haven't even broken into all-time highs yet. So I think saying things are going to end anytime soon, I think that's just not the right approach, because things are not this. It wouldn't be the same pattern as previous cycles, right? Once that we break into all-time highs, we're going to at least enjoy maybe 6 months, maybe a year, maybe even longer, because who knows? This is like the longest consolidation time frame ever, right? We've never experienced something lasting this long. And for that bear market, essentially, when it was the top, it has lasted so far 1,400 days, right? That's a long time. 1,370, right? That's a long time to be in a consolidation phase. So this is the longest time ever. And I think it's just too soon to say that we're going to have a cycle top anytime soon. And I think once we break out all-time highs, I think at least 6 months, maybe a year, maybe 2, maybe longer. We don't even know, because this is something that is uncharted and we have not experienced this before. So I think good times are still coming, and things are, in my opinion, should be no fear at all, right? I mean, minimal fear, if any. But this is looking super bullish, in my opinion, for altcoins in the near future.
I shake my head at you when you said uncharted territory. But
Why?
you know why. Anyway.
Well, I mean, we really haven't experienced it before, though. Really, you know.
Yes, I agree with that. Yes,
Yeah.
yes. Thank you. Yeah.
So we've never ever had a long consolidation this long. So for everybody saying like this is like previous cycles, it's not. We've never consolidated this long. All right, Luca, back to you.
Luca, back to you, man. What do you think?
Back to me. I mean, we've been discussing this back and forth in prior collaborations. The cycle being over. You know, I'm personally more conservative. You guys are more bullish than me. But overall, I think you know, things are looking really bullish on the midterm, and I think that this is simply a level by level market, and it should be treated as such. So, as Matt said, this is we're nearing uncharted territory. We never actually had a proper bull market when we were in a quantitative tightening environment. And now that we are nearing a quantitative easing environment, this is generally based on past price history, where generally things bottom out right after a harsh bear market. But now we're sitting at all-time highs with the markets. So who knows what will follow next? Maybe we have, you know, maybe market makers use this as an opportunity to distribute, or maybe we actually have a soft landing because the labor market is still resilient, growth is still high, the personal income and personal spending are still high. Maybe we have a soft landing and the Fed actually pulls it off. But I think that it's a level by level market and it should be treated as such. And moving forward, the best approach remains to avoid leverage, avoid being overexposed, to have a flexible approach where you're ready for pretty much anything to happen, both on the low time frames as well as on the long term. And by doing that, I believe that you can both enjoy, as I've said in the beginning of this market talk, the optionality of upside while also having a conservative approach that allows you to adapt yourself quickly to new market circumstances in case there are any durable invalidations for the bullish thesis. You can adapt yourself quickly, so you don't have to hold through an 80-90% drawdown like we've seen in prior bear markets, with people getting stuck in altcoins and they avoid, you know, getting out of them, because once they're overexposed or over leveraged, the human brain, in order to cope with the emotions, appeals to all these kinds of emotional biases. And the most frequent ones are either the confirmation bias, where people start seeking out narratives that confirm their beliefs, or the sunk cost bias, which is generally the one that happens the most once the markets roll over and we enter a bear market. People look at their positions being down 30-40%. They say, okay, I'm not going to sell here because I'm going to wait for my position to be break even, and I'm not going to sell until then. And that's how they hold for an 80-90% drawdown. And this happened with people who entered back in 2021 at the top and entered all these kinds of risk assets that were pumping, like NFTs and, all these kinds of meme coins and other altcoins. And they held for an 80-90% drawdown. I know many of them. So avoiding being over leveraged, avoiding being overexposed, having a diverse portfolio and cash on the side that allows you to adapt yourself quickly and hedge your spot holdings, I think it's the best approach moving forward to navigate uncharted territories.
But you're the Roaring Twenties guy, Luca. Can you tell us a little bit more about that perspective that you have? Because I think you're absolutely right about taking one level at a time. I think Matt and I are leaning more bullish because we're more based on some of the data that we extrapolate from prior cycles. And I think it's reasonable to be conservative and just kind of take it one step at a time. But on the other hand, I also kind of want to hear you, now that you have the great Matt speed here, also from the 1920s. I'm kind of wondering about your thoughts on the Roaring 20s too, because that's an idea I don't think we really like touched onto that on our previous collaborations.
Yeah, so my idea around Roaring Twenties is really that the Fed will. So essentially, we're in an inflationary environment, right? Where I think the Fed it has spiraled down. The national debt has spiraled down into this vicious cycle where the Fed has to print more money so that it doesn't default on its debt. The government has to issue more bonds, has to take on more debt so that it doesn't default on the already existing debt. So the whole financial system is essentially a great Ponzi scheme based essentially on thin air because they print money out of thin air. Now, my personal thesis around the Roaring Twenties is that the Fed will transition in a quantitative easing environment, start to print money once again in large chunks, and that will lead once again to an inflationary environment. But because we're in an era where technological advancement has taken over with the AI revolution, which mainly has an impact on the productivity. I think that all technological advancements relate to productivity. AI has a massive impact on productivity. You can now do something that would have taken you days, weeks in a matter of hours. And the same thing has happened in the Industrial Revolution in the Roaring Twenties. So that has related to productivity. It led to a very big spike in productivity, which leads to overall economic growth. And that has been my main thesis. But in order to see the Fed transitioning into a quantitative easing environment, I think they need a proper reason to do that, right? So they need a reason to say that we're going to make you poor again. We're going to, you know, make money worthless again, like they've done back in 2021 when real inflation was, they said it was around 10% at the top. The real inflation was around 20-25%, maybe even more. People looked at like a 2-year difference at a Costco price, and it was double. So it was definitely not 10%. We all know that the CPI and PCI are manipulated so that it fits their goals and targets, and that they do not report ever the real inflation that is going on that affect real consumers. So yeah, I mean, that's what I've been thinking, and they need a proper reason to do that. And a proper reason to do that would be an economic downturn. So everybody now worrying about their own personal well-being. And when the Fed comes in with a stimulus checks, like they've done, in the pandemic in 2020, in order to salvage the economy, people will be happy on the midterm, forgetting the consequences that, it is very detrimental for their well-being on the long run. So that's my overall thoughts on the Roaring Twenties. And I I'm a big believer in this thesis. But I think that before it, the Fed needs a proper reason to transition away from their current macroeconomic, from their current monetary policies, which would be an economic downturn.
I think
What
you and
about?
I.
Go ahead.
Go ahead, man.
No, I was going to say, what about if it was like on the 100th anniversary of 2029, just to melt up until then? Do you think that would be possible?
No, that would definitely be something. I think we're gonna see, something similar to the Great Depression later on in 2030, 2032 maybe. But now I think that if there will be in the first place an economic downturn, it will be very similar to what happened back in 2020. So essentially, the Fed transitioning very fast from their current quantitative tightening policies, transitioning straight into quantitative easing environment where they start purchasing assets very aggressively and stimulating the economy. I think there are going to be some emergency rate cuts, and maybe we have, like we had back in the pandemic, like 4 months of a bear market, of a straight downward momentum, followed by a reversal, similar to what we've seen in early April. Who knows, maybe that has been the bear market, let's say, and now we're in a new bull market. I mean, as you said, it's really uncharted territory, and I think that the best way you can navigate these rough times is neither by having an overexposure to risk assets and betting, doubling down on on this risk on environment, but in the same time also having not betting on a straight crash, right? Like a lot of people are trying to currently do, calling for a cycle top. I think that the mixed approach is the best one. So having a mixed approach, both having a diversified portfolio while also being somewhat exposed to risk assets, is the best way to go moving forward. And that, is my current interpretation
I
on the
thank you
current
for
market
sharing all
environment.
that. Yeah, that's pretty awesome. Matt, do you want to flip over to me just real quick to show a couple of things over here? The first one is really what I've shown you before, SP 500, right? The SPX, the 6-month chart Bollinger Band expansion. You've had really two like really crazy expansion on the 6-month chart here. This is the 1920s, and that led to a big correction here. This is the dot-com bubble with huge Bollinger Band expansion that could big crash over here, right? We're not really quite seeing that. If I start to see that, I would be definitely a lot more concerned. If I see more candles closing above the upper Bollinger Band here on the 6-month chart, I'd be a lot more concerned. But we're starting to kind of get there a little bit, a little bit of Bollinger Band expansion here, but I'm not seeing that crazy expansion quite just yet, like we did here in 1920s, like we did here, with the 1990s, and arguably even during this post, World War II era over here. The other thing I also want to show to us, it's kind of stupid to put a Bollinger Band on the US M2 money supply. But when you look at this, whenever you have a Bollinger Band squeeze, that eventually will lead to expansion. And when you have a Bollinger Band expansion, that leads to a very volatile move to the way up, right? This is really the first time, or the second time, I should say, ever since I was able to chart the US M2 money supply. I just take the Bollinger Band off, right? Ever since I was able to chart the US M2 money supply, which is the total USD available overall in the market, really the Bollinger Band on the 3-month chart here is only really squeezed twice. Once here back in 1995 before the dot-com bubble starts. And another time is right here where we're at right now. And it looks like the Fed is getting ready to start to print money again, and the M2 is becoming all-time highs again. It looks like there is a continued acceleration. This is in log scale, of course. It looks like there's continued acceleration in terms of money printing. So yeah, I kind of think that you're not wrong there. Now, could there be some smaller cycle downturn, things like that? Sure, but over the next few years, I'm kind of seeing something, maybe what you're referring to. Maybe a little bit of continued irrational exuberance that could last longer than we think. I just kind of wanted to share with you in terms of what I'm seeing here, that I'm charting money printing. I know it's kind of absurd, but I actually think that this does reflect in terms of what the economy is doing and what the inflation and deflation data is allowing the Fed to print money to a certain extent. And I think that we haven't really printed money there for a while. And I think that they're going to probably end up reaccelerating this here pretty soon. So just wanted to share that thought with you guys.
Gorgeous.
I know. Like some people said that this looked obscene. I'm sorry. Like you should probably just not show my chart anymore. Cause,
Well, on that note, it's been a good show. Goodbye, guys. No.
Always a fun time. No, thank you so much for because I talk to Matt all the time, but I don't get to talk to you as much, Luca. It's always good to do these kind of collaboration. I think we like to do that maybe like once or twice a month. That'd be wonderful.
Yeah, I mean, it's good catching up, and I think that having mixed opinions, not being biased in any way, is the best approach to going in the markets, really. And a lot of people tend to surround themselves in an, echo chamber where they only seek out narratives that confirm their own personal beliefs. They seek, confirmations that confirm their thesis. And I think that the best way to go is to look at different and various, perspectives, and then determine which one is it more likely to play out, and then assess the worst scenario possible that could play out, the best scenario possible, and then go from there. So yeah, I mean, it's really fun to do these market talks with you guys, and I think that it's really useful for the audience as well. So thank you for tuning by.
Yeah, thank you, guys. And I think the bottom line is nobody knows how long this bull market's going to last. But I think for the people that are just trying to call tops all the time, they're not really following the data. So the best you can do, just keep following the data and let the data speak for itself. But until next time.
All right, guys, take care.
100%.
Thanks for joining. Yep. Bye.
You've been awesome.
All right, bye, guys. Thank you.
Have a nice day.